Well, what's up, everyone? In today's video, I'm going to be talking about conventional loan requirements. We're filming this in 2023, and we're going to especially focus on the loan requirements for first-time home buyers, though we'll cover the information for other home buyers as well. And so what I want to do today is talk about conventional loans and what are their requirements. What do you need to get in order, or what do you need to have in order to get a conventional loan? And who are these loan programs for? What do they require? What should you use them for? Right. And then we're going to talk about some of the special options that you have available now with first time home buyers and other programs for these conventional loans. And so that's what we're going to jump into today. Because I've got a ton of stuff on my channel about FHA and VA and USDA, but not a ton of stuff about conventional loans. So we are going to change that. And so without any further ado, let's go ahead and let's talk about these conventional loan requirements, right? What is required in the year of 2023 or whatever year you happen to be watching this for a conventional loan? And so the big thing to know with conventional loans is that your credit score is going to determine your interest rate, your PMI, and your eligibility. And right now, just right off the bat, for those of you that just want a quick idea of what's going on, the minimum credit score requirement for a conventional loan is a 620. Now, I'll talk about this more in a second, but just because it's the minimum requirement doesn't mean that if you have a 620, you're going to qualify. We'll talk about that throughout this video. Now, something else that we need to discuss is there is a large myth when it comes to conventional loans. There is a big myth with conventional loans that states people seem to believe that you need to have 20% down in order to get a conventional loan. In order to buy a house using a conventional loan, people still think you need to get 20% down. But spoiler alert, you do not need 20% down for a conventional loan. In fact, conventional has just as low of down payment requirements as FHA and some of these other loan programs that are out there. The only ones that can really beat it are USDA because it's zero down and VA because it's zero down. And if you want to learn more about those, I have videos on the channel where I dive into all the loan programs. So that's going to be available. So let's talk about the minimum down payment requirements when it comes to conventional. So we just said that a lot of people think you need to have 20% down, and that's simply not the case. So what is the case? Well, the minimum down payment requirements are as follows for conventional loans. If you're a first-time home buyer, you can obtain a conventional loan with 3% down. If you're a non-first-time home buyer, meaning this is not your first time buying a house, you're able to get a conventional loan with 5% down. If you want to purchase a second home, meaning like a vacation property, it's not an investment property, it's a vacation home or a second home, that's 10% down. And then I put 20% down for investment properties. I think maybe sometimes you can go as low as 15%, but the rates and the points on that are crazy. Really, it gets great with conventional loans at 25% down when you're talking about investment properties. But the minimum for all intents and purposes, we'll call that 20% for investment properties. So that's your minimum down payment requirements. The only one that requires around 20% down is for an investment property. And all the others, with first time home buyer especially, it's actually lower than FHA at only 3% down. And then you have the 5% down, the 10%, and then of course the 20% for the investment. Now, let's talk about your down payment. This is going to be the case on every loan program, but I like to cover it because people who watch these videos want to know. So we're going to give you that information. Where can your down payment come from? Where can those funds come from? Well, they can be in your checking or your savings account. They can be in a retirement or a 401k account. They can come from gift funds. They cannot come from cash. Cash is not your friend when you're buying a house. So let's talk for a moment about each of these options. When it comes to purchasing a house using down payment funds from your checking and savings accounts, there's a few things that you're going to need to know. The bank or the lender or the loan officer is going to collect from you bank statements. And they're going to collect these statements most likely for the most recent or the most current 60 days that you've had those bank statements. And they're going to be looking for a number of things, but primarily when it comes to your down payment, what they're looking for is random deposits, okay? Large cash deposits. Anything that's not payroll, and even sometimes payroll if you're paid via check and not direct deposit, needs to be sourced. So they're going to look back through the last 60 days and any large deposit, let's just say it's $500, it might be 1% of the loan amount, it might be $1,000. They're going to look for large cash deposits. And if we can't source where those came from, which cash you can't, then we can't use those funds. Now, there are some exceptions when it comes to conventional loans specifically, where if you were to do a Freddie Mac, you may be able to get away with only 30 days of bank statements. But you should be prepared to do 60 days because no loan officer is going to know that until they run what's called the automated underwriting findings. And so until they run those findings, they won't know if you qualify for the 60 days or the 30 days. So keep that in mind. When it comes to gift funds, conventional is a bit more flexible with gift fund documentation than other loan programs. So let's say that a family member or an employer is going to give you money for your down payment to help you cover your down payment or to help you cover your closing costs. What that means is they're going to have to provide the lender with some things. You're going to have to provide the lender with some things to document, to show the lender that they had the funds available and that you guys aren't doing a little backroom deal where you give them the cash because you had it in cash and they're calling it a gift, right? That's called mortgage fraud. You go to jail for that. So what they require with that is that number one, the donor, the person giving you the money, has to provide you with a signed gift letter. You have to provide a signed gift letter in order to be able to use those gift funds. And so the signed gift letter is signed by you, the borrower, and the donor, and it states the amount that they're giving you, as well as the fact that it's a gift and they're not requiring you to repay it. So usually we do provide that form directly to you so that everyone can sign it. We help you fill it out and all that stuff. And then on top of that, they have to document where those funds came from. So, like on FHA, they actually have to provide a 30-day bank statement. On conventional, they are less strict. And so, with conventional guidelines, they just have to document the funds leaving the account. And then you have to document the funds coming into your account. So we don't need typically full bank statements from the donor, but we do need at least a partial transaction history that shows the funds leaving the account and entering into the donor's account or the borrower's account, your account. Now, if they were to wire the funds directly to the title company, then they don't have to provide statements at all. They can wire the funds directly to title, and then that counts as verification. So that is another option when it comes to those gift funds. And so then we got the retirement and the 401k. When it comes to retirement and 401k accounts, they're typically going to have 90-day statements, not 60-day statements, and that can create some additional documentation required if you're going to use the 401k. And the reason for that is because you may do the withdrawal or you may be in the middle of a 90-day run and you don't have it doesn't include the last 30 days. And so at that point, many times what has to happen is you have to go in and get transaction history to show your 401k. Now, you're going to obviously, most of the time, you're going to either take a loan out, you're going to withdraw from the 401k. And then what's going to happen is you're going to transfer that money into your checking account. So, usually, if you're doing a retirement or a 401k, you're going to need both. You're going to need both the retirement statements and the bank statements. And you're also potentially going to need something called terms of withdrawal. So what that is that tells the lender what the terms of you withdrawing from your 401k are. It's really important to note that if you plan to use retirement funds, that you speak with your retirement company because you're only going to have access to your vested balance and they may not give you the full balance, to use towards the purchase of your home. There are a lot of different things that people do. There are hardship withdrawals. There are loans, which we actually recommend where you just pay yourself back. That way you don't actually lose the money and then you pay yourself back with interest. So there's all these different things you can do when it comes to these 401k or retirement funds being used for your down payment. And then finally, um, not cash, right? So what do we mean? You cannot use cash. So if you have cash that's saved up in a safe, if you have cash that you've been pulling out of your paychecks and stuffing it in a safe, stuffing it under your bed, stuffing it under your mattress, we're not able to use that because cash cannot be documented. And yes, people are like, well, what if I sold a boat? What if I sold a four-wheeler? Theoretically, yes, we can then source it, but you have to have your documents in order. I'm talking notarized bill of sale, an appraised value of the item that you sold, and it all has to match up, or the lender or the underwriter can say, hey, we're not going to use that. So that is the what you need to have down for your down payment on these conventional loans. So minimum of 3% down. You have all these different areas that these funds can come from. And there's some stuff that's not included on here. I mean, if you have a CD or anything like that, as long as the funds can be sourced, they can traditionally be used. The problem comes with cash. So what is a first-time home buyer? Since we know that first-time home buyers, and spoiler alert, it's on the screen, but since we know that first-time home buyers are allowed to put as little as 3% down, conventional loans, Fannie Mae, Freddie Mac, they define a first-time home buyer as anyone who has not owned a home in the last 3 years. So if you have not owned a home in the last 3 years, you are considered a first-time home buyer. So you could have bought a home 10 years ago and then been renting for the last 10 years, or 5 years ago and been renting for the last 3 years. You're still going to be considered a first-time home buyer. So don't think just because you purchased a home once before that you can't get this, because you actually potentially could, as long as you do not currently own a home and have not currently owned a home in the last 3 years. Now, when it comes to um, mortgage insurance, okay, conventional loans have mortgage insurance, or PMI. I've got other videos where I describe in detail what PMI is, but let's just give you a quick summation of what PMI is. If you put less than 20% down, you're going to pay what's called private mortgage insurance, or PMI. This is an insurance that you pay every month directly to the lender, and the lender has protection in the event you default on the loan. Without PMI, everyone would have to put 20% down or more. With PMI, the insurance company comes in and they guarantee the lender 30 to 35% of the loan should you default, which is enough typically for them to renovate the property and get it sold and move on. Excuse me, guys. So PMI is required if you put less than 20% down. Your rates on your PMI are going to vary based on your credit score, your loan to value, that means how much you've put down, and your debt to income ratio. So the higher your credit score, the more you put down, and the lower your DTI, the better your PMI rates are going to be. And so sometimes what we'll see is someone will have like 20% that they want to put down, but you might actually get a better interest rate by putting 15% down. And then the PMI is so small that the monthly savings is actually greater because of the interest rate. Now, some of that stuff has changed recently. You've probably heard about the restructuring of the way the loan level pricing adjustments are being done on conventional loans. A lot of people said people with good credit are having to pay for people with bad credit, which is actually not the case. But anyways, so some of this stuff is a little different, and some of those loopholes have kind of been closed now. But regardless, if you don't put 20% down, you will be paying PMI. Those are the factors that your PMI will be based on. So that is one of the reasons why, when we say, and we're going to talk about it in a minute, that the minimum credit score requirement for a conventional loan is only 620. That's true. But if your scores are that low, typically FHA or USDA is going to be a better option for you, unless you're putting 20% down, because the PMI is going to be wildly expensive and the lender may not even be able to get the automated underwriting system to approve you. And most lenders out there do not do manual underwrites on conventional loans. That is more of a government loan program thing, FHA, USDA, VA. So what type of homes are eligible when it comes to conventional loans? Well, the cool thing about conventional loans, unlike USDA, VA, and FHA, is that you can purchase a primary home, just like those programs, but you can also purchase second homes and investment homes. So you can purchase multifamily, you can purchase, a vacation home, and you can purchase a primary home. Well, what type of homes are eligible? Well, when it comes to conventional loans, pretty much all types of homes are eligible. We're talking single family homes, condos, mobile and manufactured homes, barn dominiums, townhomes. All that stuff's going to be available for conventional loans because conventional loans have the most flexible property guidelines. So, when it comes to conventional loans, one of the pros of using a conventional loan is that they do tend to be more flexible on appraisal requirements than, say, FHA, VA, or USDA. Now, this does not mean that they have no requirements. It does not mean that they have no requirements. It simply means that they have less restrictive requirements. And so, where peeling paint might be called out on FHA, probably isn't going to be called out on conventional. There are just different things that you can get away with on an appraisal with a conventional loan that you can't on FHA, VA, or USDA. And the scope of this video is not to jump into the appraisal requirements, but just know you can purchase any of these types of homes. They all obviously have different guidelines and restrictions, especially condos. If you're buying a condo, it's very important you let your lender know that as quickly as possible so they can vet the condo out and make sure that it can actually be financed with a conventional loan. And then the other one that can be kind of difficult is the barn dominiums, and that's just because the finding the right comps during the appraisal can sometimes be hard, but they by no means are ruled out or you're not able to go in and do them. So that's the type of homes that are eligible. Now, let's move into the income requirement piece for conventional loans. And really, it's the same as any other type of loan. You need to have consistent income. If you're bouncing around from job to job every couple of months, if you're working, very variable hours and you don't have a history of at least 2 years of doing that, those types of things are going to create difficult issues for you when it comes to getting a loan. And so you need to have some job stability. You need to have some consistent income in order to obtain a conventional loan. Now they say you need to have a 2-year work history, and that's true. But one of the biggest myths, in fact, I was just featured in an article with NerdWallet where we discussed this. One of the biggest myths about this is that you need to have a 2-year history on the same job. That's not the case. And so where that comes from is if you make overtime or bonus or commission income, then yes, you have to have a 2-year history of that and it has to be averaged out. But if you're just base pay and your income's not variable, you don't necessarily need to have a 2-year history within the same line of work. In fact, you don't even necessarily need to have a 2-year work history because there are exceptions to that. So if you were in school, high school or college, that's going to be an exception to the 2-year work history rule. If you are a stay-at-home mom for a while and you're entering into the workforce, there are ways around that as well. And so 2-year work history is important and we need to be able to gather it, but there are exceptions like there are to every other rule in life. So, or most rules in life. So you also are going to need to meet the DTI requirements. And this is the big one. We're going to talk about this in the next slide or two. DTI is what determines if you qualify for the loan and how much loan you qualify for. So there is no minimum income requirement. Like there is no, oh, you must make X amount in order to get a conventional loan, but you do have to meet the debt to income requirements. And those kind of by default, you kind of have to make a certain amount in order to be able to afford a property. And then finally, your income needs to be provable, right? Like if you're working a cash gig, if you're self-employed and you've only been doing that for 6 months, you're probably not going to be able to get a loan, especially with conventional, because your income is not considered provable. With self-employment, you have to have a 2-year history. They average it. It has to be from your tax returns. With cash, you're technically doing something illegal and you can't document that income and show that you're paying taxes on it. It's not going to be able to be used for a conventional loan. So that's your income requirements. Now, let's talk about this debt to income ratio for a little bit. And I've got another video where I kind of break down debt to income ratio, but let's just define it so that we can understand what the heck I'm talking about. Debt to income ratio is simply your monthly debts divided into your gross monthly income. If there's 2 of you applying for the loan, it's both of your monthly debts added together, divided into both of your monthly gross income divided into your monthly gross incomes added together. Now, when it comes to monthly debts, what we are primarily referring to are debts that show up on your credit report. minimum credit card payments, auto loan payments, student loan payments. Even if they're deferred, we have to count a payment against you. Child support and alimony, those don't often show up on your credit report, but can still be counted against you. And this new one that's popping up, even though it's not on your credit report, are things like Klarna and Afterpay and all these kind of buy now, pay later services. They don't show up on your credit report, but they do show up on your bank statement. And as a result of that, if these charges are coming out every month, the underwriter will either make us have you pay them off, or you have to count those payments into your debt to income ratio, which are not great, right? It could be the difference between qualifying and not qualifying for the loan. So with DTI, the technical guidelines on conventional loans states that the DTI is capped at 43%. However, there are some addendums to this, and some folks may be approved as high as 49.99. Basically, if you stay under 50% debt to income, you could be approved, especially if you have a good down payment, especially if you have reserves, especially if you have a good credit score. You may get approved for a higher debt to income ratio than 43%. All right. Let's talk about conventional loan limits, and we're moving right along here. I think we only have one slide left. So let's talk about conventional loan limits. The loan limit for conventional loans in most areas is $726,000 to $100,000. In Louisiana, where I am, in any of your regular everyday states. However, in high cost areas, this amount will be higher. Places like California, Dallas, Texas, Austin, Texas, New York, anywhere where the average cost of just a regular old home is like $1 million, you can bet that the conventional loan limits will be higher. For the rest of us, the limit is $726,200. What does that mean? That means if you borrow an amount over $726,200 in the year 2023, these tend to go up every year, you're going to need what's called a jumbo loan, and they have a totally different underwriting structure because they're considered a non-conforming loan. Now, also, if you're buying a multifamily property, a 2 or 3 or 4 unit property is going to have a higher loan limit than a 1 unit property, which is what the $726,200 is based on. So those are your conventional loan limits. That's the maximum amount that you can borrow on conventional loans in a regular area. Again, like I said, high cost areas will be different, but those are the loan limits traditionally. Now, I want to wrap up this video by talking about some notable conventional loan programs that you need to know about. So earlier, when we talked about the down payment requirements, we talked about how if you needed 3% down in order to purchase a house with a conventional loan, if you're a first-time home buyer. One of the exceptions to that is through the Home Ready, Home Possible conventional loan programs. These programs were created to compete with FHA. So they're designed to help borrowers who are in a low to moderate income situation get better terms on their mortgage. And so because of that, even if you're not a first-time home buyer, if you qualify for Home Ready, Home Possible, which Home Ready is Fannie Mae's version, Home Possible is Freddie Mac's version. If you qualify for these programs, then what that means is you can put 3% down too. And there's some additional benefits, namely that the PMI is cheaper on these programs than on the standard conventional program. The interest rates are also typically cheaper because they have no loan level pricing adjustment. This is one of the things that created all of the uproar earlier this year, that if you were under a certain income bracket, it removes the loan level pricing adjustments, which is a fancy way of saying it makes your interest rate less. So how do you qualify for this? Well, you're going to need to be at 80% or less of the area median income limit. And you can type in Fannie Mae Home Ready, Freddie Mac Home Possible income tool, and I'll put it in the description. You can click on your area and it will tell you what 100% of the median income limit is and what 80% of the median income limit is. If you're under that limit, you would qualify for this program. Man, I remember a few years back, I was in Houston at the time, but it worked in Louisiana too. Anytime there was a natural disaster, the income limit would get suspended. And so we were able to put people in this program, and they were able to get the lower rates. And I think obviously they've stopped doing that because I probably wasn't the only one. But yeah, with these programs, it's a more competitive offer using a conventional loan. Now, the other program that I want to discuss is the 1% down payment grant programs. And I'm not going to dive into them because I just did a video on them and put it out this week. But there are now 1% down conventional grant programs. Excuse me. There are now 1% down conventional grant programs that allow you to put 1% down and the lender will put down the other 2%. Some are better than others, but utilizing this makes conventional loans a really, really awesome program for first-time home buyers in need of some assistance with their down payment. You come up with 1% on a $300,000 house, that's $3,000. The lender comes up with the other $6,000, and then you're able to buy a home utilizing that program. So that's it. That's the conventional loan requirements that you need to know if you're considering buying a house with a conventional loan. Want to talk about one other thing before I wrap this up, and that's some of the cons with using a conventional loan. And there's two big ones I want to discuss in this video. Number one, interest rates on conventional loans right now tend to be a little higher than those of FHA, USDA, and VA. So that's something to understand going into it. But just because the rate is higher doesn't mean that the payment will be. So you may still be better off using conventional loans. You have to look at both. And the second thing is that a lot of first-time home buyers rely on seller credit to help cover their closing costs. I've got a whole video on that. You can go check it out. With conventional, unless you put, I think, 10% or more down, you're limited to 3% of the seller paying your closing costs. Whereas with FHA and USDA, it's 6, and with VA, it's 4. So you get a lot smaller amount that the seller can contribute back to you, and it's usually not enough to cover all of your closing costs. Just something to keep in mind when you're thinking about these conventional loans. Hey, listen, if you enjoyed this video, when you see it on YouTube, would you like it? Would you like it on social media? Would you subscribe to the channel? And would you drop a comment? Let me know. I love engaging with you guys. And if you want to know what you qualify for, there is a link in the description. You can click that link. You can take our home buyer quiz. It takes about 60 seconds, and we'll reach out with your options for how you can finance and buy your first home or your next home. I'd love to help you with that. Click that link in the description, take our home buyer quiz, and I will see you guys next time.